The difference between a conforming loan and a jumbo loan is the underwrite. Conforming loans fit Fannie and Freddie guidelines, so they're government products. They have very systematic underwrites. They'll go down to 620 credit scores, and you can put as little as 3% down, all the way up to $625,000 if you're a first-time buyer. If you're a subsequent buyer, 5% down. So that's something, and most lenders are not doing this quite yet. But Fairway always, once we know the rate, the limits are announced, they'll go ahead and start letting us use that, and they'll just hold them on the line until Fannie and Freddie allow us to do that. So, and y'all, Larry can send you this presentation as well. So very good. The next thing I want to go over with you, and I always try to give you sales tools, and I have this pinned up on my bulletin board, so I use this all the time. And what I'm going to use more than anything is the visual. So you can take a copy of this and actually post it on social media, or when you're sitting down for a buyer's consult or even a listing agreement. The gap in net worth is widening. And what it talks about is a Fannie Mae survey recently revealed some of the most highly rated benefits of homeownership. It continues to be a key driver in today's power-packed housing market. When a person is a homeowner, they have an 88% better chance for saving for retirement. 87% the best investment plan. There's other ones if it's out of that one.
Yeah, I didn't see that one. I'm about to flash this up for everybody here.
She may have not gotten it in there. We can make copies of it for you guys. I know y'all have it.
Oh, it's on the back pages?
Maybe.
Which one's that stapled to?
Homeownership and full financial.
Oh, okay.
Okay,
I got it.
great.
Perfect.
All right. So 85% chance better off financially. What is so cool to us is when we see someone that has bought a house for $240,000 and they call you within a year to 2 years, and especially, I mean, these have been incredible years this last little while, but all of a sudden their house is worth $350,000 or $400,000. If they've lived in a house for 2 years as a primary residence, that's tax-free money that they can walk away with. This is a true story. I have a son that graduated from University of Alabama, came home, and he had a job in Auburn, Alabama, then in New Orleans, and then Charlotte. And he's looking at apartments. Of course, everybody wants to live in South End and all of the above. And make a long story short, we sat down and had the financial conversation of buying a home. So he bought a home for $209,000, lived there for 2 years to the day, and sold it for $312,000. He had $0 in it. He did an FHA loan through North Carolina Housing. So he had assistance going in, and there was a deal that had fallen apart on the house that was FHA. So they already had the appraisal done, and seller was willing to pay closing costs. So, I mean, $0 in. So he went from a broke college kid, had just still on his first job, and walked away, all said and done, with about $80,000. So, I mean, it's incredible. But whether it's a young person, whether it's a single mom, whether it's a family, home ownership is the easiest way to save money in the world. And you guys are in the driver's seat because you're the ones that have the ability to lead them to this. They will never, ever, ever forget the impact that you had in their financial life if you do this for them. So again, first-time home buyers, our average price point now in the Charlotte metro area is about $320,000. So the days of $100,000 property, the days of a $200,000 property are tough. So, and we see it rampant where we are because we're in Mooresville. So the growth there has been really tremendous. and mostly because of the I-77 toll lane. We see it in Denver because again, that's another side of the lake. So it has just been incredible. But Charlotte Metro is in the top 3 to 5, in the top 3 to 5 housing markets in the whole country. So it's been amazing. Larry, yeah, there's more out there. But anyway, no one can question a person's unique feelings about the importance of homeownership. However, it's fair to ask if the numbers justify homeownership as a financial asset. Last fall, the Federal Reserve released a survey of consumer finances. It's only a report that's done every 3 years. They found that homeowners have a 40 times higher net worth than renters. 40 times higher net worth. Is that astounding? The difference between net worth of homeowners and renters continues to grow. And here's the graph showing the results of the last 4 Fed surveys. So this was huge when it came out. It's even greater now because rents are going up like crazy. There are many, many, many investors and REITs that are investing in neighborhoods, building neighborhoods where they're houses, but they're going to be rental properties all the way through. So it's kind of a different world than we've ever seen before. If you flip over to the back, it continues this comment. The equity held by homeowners grew 26,300 over the last 12 months alone. That means the gap between the net worth of homeowners and renters has probably widened even further over the last year. Some may agree the difference in net worth may be due to homeowners normally having larger incomes than renters and therefore the ability to save more money. However, a study by First American shows homeowners have a greater net worth than renters regardless of income. And then of course, it backs it up with additional findings. Income level as low as 26,000, owner net worth, renter net worth. So owner net worth was 100,000 versus 1,000 with the renter. Is that incredible? So this is something that is a phenomenal sales tool. Yep. But it talks about people, homeowners 65 and older have a 47.6 times greater net worth than renters. So the idea of homeownership is a direct way to build your net worth. It has met the test of time. So let's connect if you're ready to take the steps to become a homeowner. So outstanding article, regardless of the age of your buyers. Does anybody know the average age of a first-time home buyer now? Anybody want to guess?
26.
33 years old.
Yikes.
And I was in a seminar last week in Nashville, and there's a company called MBS Highway, and I joined them years ago. And what MBS Highway does is it tracks the treasury bond, it tracks mortgage bond securities. So anytime those bonds move and change, it allows us to get a phone call and an alert of when rates are moving, like, lock now. It's a lock alert because we know that rates are moving and it will tell us what's going on with the bond and the daily moving average and all of the above. Well, one of the guys that owns MBS Highway spoke to us. And so many of us are hearing people say, well, I'm going to sit out of the market and I'm going to wait to buy because prices are going to come down. History repeats itself, but never exactly the same way. What happened in 2008 is not what's going to happen in 2022. In 2008, people were allowed to take out different types of loans, but in particular, most early on buyers had an opportunity to do 80-20 loans, which is 100% financing. Then they were pulling equity lines out regularly because there were no caps on how much cash you could pull out. And they ended up owing more than the value of their home. So when the bank wouldn't work with them, they just walked away from their home. Well, now we have so many rules, on qualifying borrowers to even get them a loan. But B, even if they do cash out refinance, they're capped at 80% loan to value. So they can never borrow more than 80% of the value of their home unless they do an equity line or something with a bank that's not Fannie and Freddie. And they can get a little more money out that way. But a regular mortgage on a cash out refinance is capped at 80%. On a purchase, as we talked about, now you can go up to 625,000 on a purchase conventional, backed by the government. The highest you could ever borrow is 97% for a first-time home buyer. But for a regular buyer, it's 95. So there is no more 100% financing for anyone unless you're a veteran or you qualify for USDA. Those are the only 200% financing loans out there. So the next article that we're going to go through, it's going to segue into what is a credit score. So as we go through this, we're going to kind of look at how these work. But 15 home buying myths that your parents told you debunked. So if you can get this out into the general public, how many people do you think believe that you have to have 20% down to buy a house? That is the greatest fallacy out there. But that's the greatest hurdle that you guys are ever going to face. If you can let people know that 3% is all you need on a conventional loan and 3.5% is all you need on an FHA loan. FHA, you do not have to be a first-time home buyer. So unlike a conventional loan that will go up to 625, FHA is currently capped at 331,700. They will announce towards the end of the year if that number is going to go up for the year, which I'm sure it will. But FHA has a capped loan amount, but it will go down to a 580 credit score. So credit scores don't mean everything. It depends on what's on the credit, but at least it will allow that to occur. Conventional loans are 620 credit scores. So, but you don't have to have 20% down, 3%, 5%, 3.5%. When your parents were telling you those stories, rates were probably between 6% and 20%. As we sit in this room, I'm 61 and my first mortgage was at 14.5%. And that was in 1984. So it's incredible to see that even with rates moving up, we're still in the threes. So that does nothing but increase buying power. So even with prices going up, your buying power is still much greater. So let's continue with the most common fears of buyers. You should spend about 30% of your gross income on housing. 30% for necessities, 30% for savings, investments, and financial goals, and then 10% for fun. So again, it's called the 30-30-30-10 rule of personal finance. People with no debt may be more comfortable spending more than 30% on their home. So it depends on how you handle your finances. But even as a real estate agent, I've done enough real estate agents' mortgages to know that it's very difficult to truly understand how is a lender qualifying a borrower. We use gross income. So gross income means before taxes have been taken out. So if an average borrower walks in the door and they make $100,000 together, so 50 and 50, we're going to take that $100,000 and we're going to multiply by 43%. Ideally, we'd love for all their debt and their housing debt to be within that 43%. So what we do is, let's say that that's 43,000, then we're going to divide it down by 12 months. All right. All we have to do quickly is subtract their debt, and that tells us how much is left for their house payment. Another way that we back into mortgages is we'll say, what are you currently paying for rent? $1,200. Wow. First of all, did you know that $1,200 a month is $25,000 a year that you've given someone else? But, and actually it's in 2 years, but all you're gonna do is multiply by 12. But when you're doing this, you're actually going to let them know that we're gonna calculate that payment close to what their comfort zone is. So we can work numbers backwards. And then of course, if they have minimal debt, we can remove that. $50 to me in a credit card bill is worth $10,000 to my borrower that's borrowing money. So if you've got an ink pen, you can write this down somewhere where you'll always be able to find it. You may want to write it on your credit document or something. But the rule of thumb, this is just easy math. It's called the rule of 1 in 5. When you're financing a loan, every $100,000 equals $500. Every 10,000 equals 50, and every 1,000 equals 5. So when you are in heavy duty negotiations and you've got borrowers that are 10,000 off, you're going to say, you know what? Would you let $50 stand in your way every month? Would that make a difference? No. But now you've educated your borrower. Or if they say, what would a $300,000 mortgage cost me? Well, you can do the mental math, 5, 10, 15. All right, $1,500 is what it's going to cost you. And then you've got taxes and insurance, and you've got maybe some mortgage insurance. But remember, it's not sales price, it's the mortgaged amount. But that rule of 1 in 5 will make you a lot of money because you will become the best negotiator out there. Okay, so
Y'all get that? That's good.
yeah. So anyway, they're telling us different numbers here of gross income on housing. This is just good to sit down and be able to educate people. The next page talks about conventional and government loan products. So conventional loans we just talked about, we like those to stay before a 43 total debt of your gross income, including your consumer debt and your household debt. All right. But let's say that we've got a borrower that wants to go FHA or VA. And I want you to notice that I'm not throwing in that third one, USDA. It's a whole nother ballgame. But FHA and VA, as buyer's agents and as listing agents, VA and FHA are the easiest loans to underwrite in the world. Easiest, most relaxed underwriting rules in the world. And as agents, there are so many agents that truly don't understand the loan side of things, and that's not their field, but they won't accept an FHA loan or they won't accept a VA loan because they've heard all kind of crazy things about FHA and VA. So we're going to go over a few FHA facts and a few VA facts. FHA requires 3.5% down. It's got the most lenient rules for bankruptcy, foreclosure, deed in lieu, any of the above. It excuses them in a much shorter period of time than conventional loan does. It excuses them. So the debt ratio that we just talked about on conventional, they like that to stay around 43. Well, FHA likes for it to be around 45, but I've gotten an FHA borrower through on a manufactured home at 54 and change. So FHA will allow the debt ratio to go above a 50. Again, it depends on what's on the credit. So don't be afraid of FHA. If an FHA appraisal comes in and the property does not appraise, that FHA appraisal is going to stay with that property because it's got an FHA case number. So you can't accept, if that deal falls apart, you're not going to accept another FHA loan, okay? Because the appraisal sticks with it. It's the only loan out there that the appraisal sticks with. It doesn't stick with VA, doesn't stick with conventional, doesn't stick with USDA. All right? But don't be afraid of FHA loans. Government loans are a little more particular on rickety staircases. They act as an inspector because these borrowers don't have a lot of money. So as long as you don't have anything to hide and your house is safe and livable, you got decent roof life on your roof, do not be afraid of these. VA is even more lenient than FHA. Those people served our country. You can't get a VA loan unless you served our country in war or put 4 years into, and actually I think it's 3 years into the military. You have to have an honorable discharge. Those people deserve a home. And because of not knowing facts, you've got all kind of agents that won't accept VA loans. A VA appraisal, we have a timeline on VA appraisals. They are different. We can't order them through our panel. We have a panel of appraisers when we know who our appraisers are going to be. Different than Bank of America. We're not sending a Rock Hill, South Carolina appraiser up to Lake Norman to appraise a waterfront property. We have special appraisers that are going to hit special areas. Does that mean we're going to meet purchase price every single time? No, but it won't be because we don't have an educated appraiser.
Is that on VA or on
Anything. VA is different. You have to order a VA appraisal through VA.
Okay.
So we have not a clue who's going to show up there. But when we call VA and say, we ordered this appraisal on so-and-so day, where's our appraisal? They have 24 hours to respond back to the VA when we call on that. They have 10 working days to get that done. So all we have to do is report it to VA, and then we'll know, we'll get something from them as soon as they get something. So third loan product I want to talk about is USDA. Has to be a USDA eligible area. How many of you have ever done a USDA loan? All right, they're 100% financing, but they're very, very, very persnickety. They will not allow the front ratio, which is the housing ratio, to go above 29%. They can meet every criteria in the world. But if that ratio doesn't meet 29%, or maybe close to whatever they're paying, it will, that's the only caveat, is if they're paying more than that, then it will work. They have to have a 12-month rental history, Can't have a bunch of assets. So make sure if you ever do a USDA loan that you have a knowledgeable lender, because that is an oddball loan. It's a great loan, but it has a lot of things. And if you mess up with a buyer, they'll never forget you either. So you don't want to do that. So
just throwing this out there, there is a site that you can search to make sure that property qualifies, because most listing agents do not know that. So you can actually look it up.
Yeah, and it's more than just if it qualifies. There's so many caveats. If they're outbuildings, they give them zero value. If they have money, I had a kid that was had inherited some money from a parent on a retirement account. If you have more than a little bit of money, you're not going to be a USDA either. So, I mean, just all kind of weird rules where those rules are not available in any of the others, but don't be afraid of VA or FHA.
I got a question.
Yes, sir.
So the person coming in with the least amount of money in pocket, worst credit, what is the best
FHA.
option? FHA.
Not a question.
Okay.
Absolutely not a question. Even if down payment assistance from family or friends is off the table, most cities, counties, states have a down payment assistance program. And North Carolina Housing does have a very, very good program. First-time home buyers, come on in. First-time home buyers are offered $8,000. You have to have a 640 credit score, and you have to have a 43 deck ratio. It will not go through. It can be a 43.1. But on all loans, down payment assistance are gift funds from family. You're more than welcome to use, but family as mother, father, brother, sister, grandmother, grandfather, aunt, uncle. So it does need to be a family member. You can't get it from a friend, and you can't get it from work unless it shows up as a bonus. So housing prices have skyrocketed in the past year. Many young buyers are coping with the rising cost of living, student loans, and other financial barriers their parents' generation didn't have to deal with. It's not worth missing out on building a years of home equity just to say you didn't ask anyone for help, especially when you're not ready. So again, going back to FHA relaxed student loan rules this year. And what they did, if somebody has $100,000 worth of student loan debt, we used to have to count $1,000 or 1%, no matter what. Now, if it's a zero payment on there, we have to count 0.5%. But if they are making income-based repayment, we can use that. So that's a big, big, big rule that changed this year. So again, FHA is going to entertain so many more borrowers than any other type of loan. You should only buy in a buyer's market. And again, y'all can read these, but the phrase buy low and sell high is solid advice for the stock market, but it doesn't exactly hold up in today's housing market. So it can take years for the housing market to change directions, and buyers waiting out the market may end up on the sidelines for way longer than they expect, all while paying rent instead of building home equity. So again, a lot of these are great, great sales tools. So as I said, we're going to segue into credit. So this little section in the back says you need excellent credit to buy a home. That's another big, fallacy. You don't have to have 20% down. You do not have to have perfect credit. So your credit score plays a very important part in the role of a home buying process. It affects your interest rate and the strength of your offer. Just because you're not rocking a 780 credit score doesn't mean you can't buy a home. So we're going to go into this document here. And again, Larry's got these. He can send these out to you. But it basically says, what is a credit score? Excellent, 8 to 850. 750 to 799, very good. 700 to 749, good. 650 to 699, fair. That's a real shocker for most people. Poor, 600 to 649, and really poor. But how do they come up with these? A credit score is a numerical representation of statistical likelihood that you're going to default or repay your credit. It's a snapshot of a specific moment in time that can and will change with new actions with the passage of time. So even as a loan officer, this visual was fantastic to understand what goes into a credit score. So people that open and close credit cards all the time, that hurts them. They want to see, that you can manage your credit, but they want to see how long you've had your credit. So if you have a credit card from 2009, good for you, because now all of a sudden, you have a 12-year-old credit history. All right. So it's the length of time, your payment history, the types of credit. Do you just have revolving, or have you been able to make installment debt, which are car payments? Credit length, amount owed. So I want you to look at the length of credit is 15%, where payment history is 35. So, I mean, that's huge, keeping your cards open for a long time. So
does it matter if you use those cards or not?
If you do not use them occasionally, they will close them for you. So yes, you do need to use them. But what they want to see is not how many or how few you have, but how you manage them. So I always say, if you just buy a tank of gas a month and then pay it off, that way you've got utilization and you're not carrying big balances. Where we see people mess up is they'll get rid of all their credit cards and they'll have one, and they run that bad boy all the way up. If it's got a $20,000 limit, they're $19,999. That plummets your score. I do believe in paying attention to your credit, but people need to understand Credit Karma is not real. Credit Karma is a marketing company. It is not a credit company. All they do is collect people's data and sell it. That's all they do. The credit scores that they put out are nowhere even close to what we pull through. We may have somebody that's got a 720 on Credit Karma and they've got a 660 with us. So, but Credit Karma is not lending them several $100,000, and a bank is. So this is a phenomenal tool. And while we've got this, when we pull credit for a borrower, it comes up with 3 scores and every trade line they've ever opened. So what we look at in the beginning is it gives us all 3 scores, and then underneath their score, it might have 50, 30, 45. And what that means is that's their potential to move their score up. So we may have a borrower that's got a 640, but they've got potential to move that score up 80 points. So we hit a button and it calculates, and it tells us exactly what that borrower needs to do. Take your Visa card ending in 3390, pay it down to $2,000. Take your MasterCard ending in 1234, pay it down to $10,000. So it's going to tell you exactly what to do. All right. While we're talking credit, and we're going to kind of encompass our whole conversation, let's say that we've got medical collections. All right. If you have an FHA loan product, they're going to not even look at them at all. All right. Even though they adversely affect your credit, and we'll have a heart surgeon buying a $1.8 million house, and his wife missed one medical, and it might be for $60, and it will plummet their score over 100 points. You might have another guy that's got a whole sheet of medicals on there, and somehow they still have a 680 credit score. So it's crazy the way credit works. But medicals are not looked at the same as if you don't pay your Visa card, or you don't pay cable. You don't pay, and we'll see people that pay all their bills on time, but they have collections on their phone, their cable, dish, and they're chronic at it. You know, like if they don't like Dish, they'll go to Spectrum. If they don't like Spectrum, they'll go to the next guy. So they look at behavior, and that's really what a credit score is. So and it tells you on the back, maintaining favorable credit scores. Order a free credit report on annualcreditreport.com. Pay all your bills on time. Even a 30-day late notice on a small credit card can have a significant negative impact. Late payments on your credit card will never negatively impact your credit scores. Do not close old revolving accounts no longer in use. It helps your scoring when accounts are open with zero balance. Okay. Again, that's the longevity. Inquiries, and this is a really huge problem. People that just let like 5,000 people blow their credit. It's like, what are you doing? And underwriters look at that. They look to see how many creditors have pulled their credit. And they look for 120 days, it just appears on every credit report. So if a person went, the worst part is if they go to buy a car and they apply for financing at the dealership, they may have their credit pulled 12 times. So it's not going to hit their credit like they went and applied at 12 different credit card spots, but it does really adversely affect their credit. So
Question. For the mortgage, when the client is looking for mortgage, how many times do you recommend them shopping around?
I'm going to be honest with you. I think that 2 would be the max that anybody really should. But I think that as a real estate agent, I know that y'all are not supposed to steer people in a direction, but there's nothing wrong with saying, this is who I trust. You know, you can use anybody you want, but this is who I trust. I do it with insurance people all the time because we have to estimate insurance. But I know those guys are going to call me back. I know that I'm going to have my deck page in time, and I know my clients are going to give a fair deal. So having people go to 43 different lenders because they think they're going to get some smoking deal somewhere, really? If you don't close that borrower after you put them under contract, it's on you. because you're a professional and this is what you do for a living, and they're a consumer and they have not a clue what they're doing. And whether it is an older couple or a younger couple or a middle couple, how long has it been since they've never bought a house, or it's been 5 or 10 years since they bought a house, or it's been 3 or 4 years. The last time they bought a house was before the world fell apart. You are their educator. The better that you do your job, the better transaction you're going to have. So find the lender you trust and use your lender. If there's something that goes awry and you're not comfortable with it, but you let them know they've got every option in the whole wide world. But there's a lot of crooks out there. It's a lot online. I just cannot fathom anybody putting all their data online. Because we see the fraud side of it on credit reports every day. So, but I'd have people you have in your pocket that you trust without any question. So,
I have a question.
uh-huh.
The simulator that you were saying that you all use, is that similar to what individuals do on like MyFICO?
No,
Okay, it's different. Okay.
ours is very specific and it will tell us the likelihood, like when we hit a button, it'll say, we put in that we need a borrower, we want the borrower to go up to a 720 credit score. And because everything in our world, this is a great thing for you guys to know too, is done by increments of 20. So 660, 680, 700, 720, 740, 760. And that's how loan pricing is done. And that's how mortgage insurance is calculated. Okay. So does that help? Does that answer?
Yeah.
But when it tells us their potential, like if it's only going to get us to a 745, we're going to put in 740 and it will tell them exactly what to do, because we're going to throw away the high score. We're going to throw away the low score. We work off the median score. So we may have to manipulate 2 credit bureaus, not 1.
And
But
are you able to, if they show that they have done those things?
3
the credit
days.
okay.
Yeah, 3 days. Mhm.
Okay.
Yep. And that's why we're doing it,
Okay.
is so that we can help the borrower. And we can also lock them today, and we own that rate sheet.
Mhm.
All right. So when we're quoting a rate, we can say, if we lock this rate sheet today and your credit score does go up to 740, we have sealed this rate sheet. So this is how your rate would change. Okay. And again, it'll give you 85% likelihood or 90% likelihood if they do exactly what we say. And it never says pay it 0, ever. It always says pay it to $10 or pay it to, and we've had buyers that have gone beyond what we've told them to do, again, by paying it to 0, or maybe they close something. And it's always those on edge borrowers that you're doing a miraculous service anyway. And then they go and do something dumb. It's like, oh no. So then you gotta start all over again. So, all right, couple of things here. And really, I'm going to go out of order because I don't know, like I hate Zillow, but I love Zillow because I use Zillow every day of my life and my job. When y'all send a client to me and they are looking at a property, you don't ever tell me that each address that you're showing them. But they're going to call on a special one, and I can go on Zillow and realtor.com and I can look up property taxes is what I use it for more than anything. On a refinance, I'll look at Zillow and I'll look at realtor.com and divide by 2, and that's how I get my value instead of getting a realtor to do a CMA or whatever, because we, but Zillow has really made a huge impact in our world. And Zillow and Open Door have come into the Charlotte market with a frenzy. And they have taken lots and lots of listings away from you guys by offering people more money than you could ever get on the open market. And they don't have to pay a commission. They pay a fee, but it's a service fee. So guess what? Zillow's in trouble. They're having to sell a whole bunch of their houses for way less than what they paid for them. Because instead of having boots on the ground and actually looking at properties, and Open Door is the same thing. They just offer and close. They'll give you 90 days to move out so you can find something else. So the deals are just incredible. But supply chain challenges that are straining the housing market are having the same effect on iBuying giant Zillow. The real estate platform announced October 18th that its home flipping business will be taking a break from signing new contracts as the company addresses a backlog of its properties still in its renovation pipeline. We're operating with a labor and supply constrained economy inside a competitive real estate market, especially in the construction and renovation projects. So they started by telling you that they're not buying and they're going to stop till the end of the year because they have a backlog of renos to get done. As this has gone on and they found out a lot more about this, they're in trouble with this. And not only did they enter into the real estate market, but they wanted to do mortgages. They wanted to hog everything. And I don't know if y'all have ever read the book, The One Thing. You need to be real good at one thing. And that's it. Okay. So this is quite interesting. Keep your eyes and ears to the ground. You may want to research this a little bit because this is what you do. Be well informed. But this is a really good article telling you about them. I'm going to keep going. I've got just a couple more things. What does the future hold for home prices? If you're looking to buy or sell a house, chances are you have heard talk about rising home prices. While the increase in home value is great news for sellers, you may be wondering what the future holds. Will prices continue to rise with time, or should you expect them to fall? So you need to understand appreciation, depreciation, and deceleration. Okay. So it's important to note home prices have increased or appreciated for 114 straight months. To find out if that trend may continue, you look at Pulseonomics surveyed over 100 economists, investment strategists, and home market analysis for asking for their 5-year projections in terms of what lies ahead. Now, remember when I started this, we talked about MBS Highway and going to Nashville and listen to this guy talk. What they do, what economists and strategists do, they go back to the average age of a first-time home buyer. And they look at that period, 5-year period of birth rates during that time. Well, they know based on that 5-year period that we are not going to slow down on housing need, okay? So if a developer were to go buy a piece of land and decide that that's the perfect spot for them to build a neighborhood, before they even put a road in, by the time they get all the things that they have to do and get through the county and even to say you're allowed to build there, you're looking at more than 2 years. So y'all have got to sell houses that are existing and talk existing housing into selling. So this is going to give you, all these are going to give you great information. But here's your estimated home prices through 2025. 2021, 11.74%. 2022, 5.82%. And again, these are based on statistical models, and we just talked about until there are boots on the ground throughout these time periods, they're never going to be exactly right because Zillow was way wrong. But as they estimate these, you can see houses, rising prices are going to continue through 22, 23, 24, and 25. So that is an increase, but again, your third word was deceleration. So it's happening at a slower pace. The graph above shows prices are expected to continue to rise, not just at the same pace we've seen over the last year. Over 100 experts agree there's no expectation for price depreciation. And as the arrows indicate, each number is an increase, which means prices will rise each year. Bill McBride, author of blog Calculated Risk, also expects a deceleration, but not a depreciation. So again, slowing down, not lowering prices. So if you're a buyer, don't expect a sudden or drastic drop in home prices. And it amazes me, the people that I talk to on a regular basis that think that this is just going to stop and they're going to have a smoking deal next year or the next year.
What's gonna slow down the prices? Is it gonna be rising interest rates or less demand? What's predicted?
Well, demand is out there, but anytime things cost more, there's a combination of all the above, but rates are going to rise. But again, if you think back to our earlier conversation, like my first mortgage was at 14.5%. 8% is the average of a lifetime. The fact that they have been in the 3s and even the 2s last year. But our federal government has been buying treasury bonds and mortgage-backed securities to falsely hold this low. So even though they're going to continue to buy, they announced last month that November, they're going to begin to start pulling back on the numbers that they're buying. Okay, so as they do that, and then naturally, I want you to use this for your own personal knowledge, but as you're selling, every time you drive up to the gas pump, what's going on?
What's going up?
Every time you go to the grocery store, or to a restaurant. So inflation is a very, very real thing. And we had a president named Jimmy Carter when I was in college, and Jimmy Carter had rising inflation like this, just out of control, which was why my mortgage rate was 14.5%, which is why the word ARM, ARM, adjustable rate mortgages came into the picture. So my friend over here is shaking her head because she knows all this story. So, but you're going to see things change, and ARMs are never good when rates are low, but ARMs are great if rates accelerate, okay? Because it's just giving it to you for a shorter period of time. But there's many, many, many things that are going to attribute to. But again, it's showing you your appreciation. Your demand is still going to be very, very great. So it's like you can see your numbers. So it's still strong. But you've had like record years that, you know, we've never seen in the history of housing. So, all right, the next thing, and this is just a cheat sheet for you guys to have. And things change every day. So this is never all the way updated, because the day you update it, then they're going to change something else. But this is something that like you can keep in your glove compartment. It's that cold. Talks about every loan, FHA, conventional, VA, and jumbo. All right. So on the left-hand side is your guide. Max loan amount, monthly mortgage insurance, PMI can be removed, upfront funding fees, appraisal, maximum debt to income, minimum credit score, rate hit for low credit, student loan payment calculations, minimum down payment, gift restrictions, seller paid closing costs. How many times do you wonder what you're allowed to ask a seller to pay for closing costs? FHA, you're actually allowed to ask for 6%. Okay, conventional 3%, VA 4%, jumbo 3%. So bankruptcy. If you've had a bankruptcy and a client asks you this question, you pull this out of your glove box. Yep, you can go FHA after 2 years of your discharge date, but on a conventional loan, it's 4. Look how smart you look. Okay. Well, we had a foreclosure. Do you think we can buy again? Pull out your cheat sheet. Well, on FHA, 3 years, conventional 7 years, VA 2 years, 2 years, jumbo 7. And jumbo, they can put 7 all they want to. If you've had a foreclosure, most jumbo people are not even gonna look at you sideways. So short sale deed in lieu, condo requirements, title vesting, So let's say that you've got a boyfriend and a girlfriend trying to buy a VA home together. Did you know that they can't do that unless they bring down payment, even though it's 100% financing loan, unless they're married? The co-buyer has to bring their part of the down payment. So there's a calculation for that. So, but this is awesome. Did you know? So let's go to PMI, mortgage insurance. All right. So did you know that on an FHA loan that mortgage insurance is on there for life? It never goes away. Did you know on a conventional loan that it's only 2 years or 20% equity from the original sales price? VA, not applicable. That's the cool part about VA. Did you know that all government loans have a funding fee up front that's rolled into the loan? Every FHA borrower pays 1.75% to the government. They give 3.5% down, and then the government charges them 1.75% up front to pay all the VA salaries for real. And then mortgage insurance goes on for life. So it's the easiest loan out there, but they're paying deeply to get it. So, but this is one of my favorite things, and I stole this from another Fairway loan officer. I thought it was the coolest thing ever. And then anytime, if I ever meet with you guys, I'll always try to give you some social media stuff. And this is, it's a seller's market due to a low supply and high demand. Today is one of the strongest sellers markets we've ever seen. So it kind of goes through that it's a great time to sell, sellers benefit from. So just a wonderful thing to help you potentially get listings. And then reasons renters buy. Rents have been rising aggressively for decades, but in the last 12 months, I mean, you should look those stats up if you've got a renter. It's insane. Home buyers can lock in a set monthly payment for 15 to 30 years. Home ownership helps build wealth. Renters have a substantially lower net worth than owners. When you buy a home, your monthly payments build equity, by extension, your net worth. So owning a home gives you more flexibility, et cetera. Another one of those big fallacies too is if you buy a home that you can never sell it. Well, what if our like we may change jobs down the road, then sell your home. If you have a transfer letter, if you have been moved by your company and you've owned your home less than 2 years, then you can move out and still not pay capital gains. So that is a lot of information. So y'all should be the smartest guys on the block after this. So,
Hey, let's see if anybody online,
Yeah.
does anybody online have a question? Pop up. I bet you can't stump her.
Is it possible for us that are online to receive a copy of what she is sending? I joined late. I apologize.
don't
Well,
worry. And if Larry is in a good mood, he'll send it right to you. Okay.
Yeah, I'll get it. I'll get it to
Awesome.
you.
Yeah.
Thank you.
And again, we'll get business cards over to you, an electronic business card over to you, so you've got it. But my office is in Mooresville as my main office, and I certainly would be honored to help you guys with any mortgages of any type. So questions, I know that's had to.
On the non-conforming or conforming loans,
Mhm.
the limit 625 is now, it's been raised to that.
So 624,999 keeps you below jumbo loans. Mhm.
Is that only for like, can you apply that to like second homes, or is there more?
Yep.
So
Yep.
there's no like restriction. And is that area still like, you can still put 10% down?
10% down on a
Cause
second.
I heard some like,
It went away when Calabria left the government. It went away. He had imposed where lenders were only allowed to have so many second homes and investment
right, that's
properties.
what I was
It's
confused
gone.
by. So
It's
that's
gone.
gone. And then interest rates on those types of properties.
About the same.
Okay,
Yep, about the same. The only big difference with a second home and a primary is if you do have to have mortgage insurance, you can't just pull it off at 20% equity. It's a little different on those. So that's a big difference. And note too, like if we're calculating a payment for someone, whether it's a second home or a primary. If we have a debt to income ratio limit, you can always do an upfront PMI. On second homes, they have to put 10% down, so it can't roll into the loan. But on a primary home, it can roll into a loan. So it does change your loan to value, but it can't roll in. So, yep. Any questions from you back there? You good? Online, any of you guys have any questions at all?
Everybody's muted.
Okay.
They're so smart.
All right. Well, very good. Yep.
Everybody
yep.
online, I'll get this over to you guys. We'll send it out to the whole office. So I'm assuming it will come from Melissa, maybe? Okay. Look for an email from Melissa. Thank you, guys. Y'all are awesome.
Thank you. Thank you.
In meeting.